Welcome back to Palisade Radio. I'm your host, Tom Bodrix. Joining me today is Gary Wagner from thegoldforecast.com. He's a technical market analyst for the last 35 years, a frequent contributor to Stocks and Commodities magazine, and the editor of thegoldforecast.com. He's also a daily market commentator for Kitco. How are you today, Gary?
I'm doing great. How about yourself?
Excellent. Glad to have you. How are things in Hawaii?
It's a pandemic like everywhere else, but we're so isolated. If you got to be isolated, I'll do it in paradise. Hawaii's nice. I love it here.
I can't blame you. So I'd like to get a couple of your thoughts on the recent price movements in the metals. We haven't seen a stimulus bill yet. So are the charts signaling a buy signal for you? And has it been surprising to you?
We bought right before the election because the polls indicated that it was most likely that we'd get a Democratic president. If that happens, my assumption was any fiscal stimulus that came out would be larger than if it was a Republican president. That being said, the Senate held on to the Republican majority, so it's going to be kind of a check and balance scenario. I think what we're seeing is buy the rumor, sell the fact, in that people are waiting for some sort of fiscal stimulus. It's going to happen. It's a matter of when, not if. And once the announcement came that we were pretty confident that Biden had actually won, we had extreme volatility in the market yesterday, but then this morning it just took off like a rocket and moved up $50. So I think we're seeing the first part of a nice run, and that run could take us substantially higher.
Yeah, and of course, we're speaking here on November 5th, so 2 days after the official election was held, but we, of course, officially don't have a result right now.
Correct.
But let's talk a little bit about the stimulus package. Some say we're not going to see it until possibly February. So what, in your opinion, could the economy really use right now?
Well, the economy continues to contract. Some businesses are doing exceedingly well. We just had the Fed meeting ending, and the announcement was they're going to leave interest rates unchanged. Whenever the Federal Reserve does quantitative easing, whenever they're doing large purchases for their asset balance sheet, it is very bullish for gold, and it's very bullish for U.S. equities. In fact, typically, investors look at these two asset groups as diametrically opposed. One is that risk on equities. The other one is safe haven. It's comfortable. But the fact is that quantitative easing is one of those unusual circumstances where both markets will run in tandem to the upside because of quantitative easing. And so I believe that we're right in that scenario currently. Now, to answer your question, I agree that they probably will not do any kind of fiscal stimulus till next year. The reason being is they'll want the next president in to get a bigger bill passed.
Mm-hmm. So in your opinion, Gary, I know you were talking about that the Fed won't go to negative rates. So why is that?
I don't think it makes sense. I think that they're basically zero now. They're between 0 and a quarter basis point. To me, there's no reason to go negative. I think that they have more tools that they can use. If you look back at what they did during the 2009 financial crisis, they had QE 1, 2, 3, and then the wind down 4. But 3 was interesting because it was called twist. And all they were doing, they were swapping long-term and short-term. They were kind of moving the yield curve around between different various lengths of financial instruments. And so they have tools that they can use without going negative. I don't think that there's a reason to do it. And I also think it's detrimental, especially to the banking system.
Mm-hmm. So as you're talking about the 2008 financial crisis, can you share with us some similarities and differences to what we're seeing right now? I know you said that in 2008, there was a specific problem that could be solved, and we don't necessarily have that right now, correct?
You hit the nail on the head. That's precisely what it was. In 2009, we had a financial crisis. We identified what the issue was, which was terribly bad loans, a lot of bad paper. And the way that they solved it was the Fed ended up buying a lot of the garbage paper, but there was a solution to it. The solution to a pandemic is to not have a pandemic. And the only way to get there is going to be a vaccine. And so I adamantly believe we'll probably get a vaccine that's viable and available to everyone probably by March, maybe second half of next year. We might have something at the end of this year, but that would go to first responders and those that really need it. But the thing is that when you're working a financial problem out, you can set a timetable as to what it's going to take to achieve these tasks. When you're developing something that's never been developed, although you have techniques you've used for other viruses, it's very, very difficult to have that same kind of timetable. One. Two, you have efficacy. In other words, just because you've produced something that you believe is going to work, you've got to go through a rigorous testing period before it's administered to millions of people. And so you can't predict how long that will take. That, I believe, was the biggest differences between 2009 and currently.
So, Gary, you recently wrote an article kind of comparing the budget deficit that we've seen this year. You know, it's been an all-time high budget deficit, and you were kind of saying that 2021 could be even bigger. So could you share with us a little bit more about that, please?
Absolutely. We were in a unique circumstance during this year in that the Treasury Department had to allocate $3 trillion, the CARES Act, in order to help the unemployed people, prop up businesses with the PPP program. And it was something that had never been needed before. And so it gave us the largest number in history. Now, as we go into 2021, we're already in there in terms of the fiscal year. There's a lot of work still to be done. And I believe that they're going to need to put up at least another $3 trillion to kind of shore things up. And that's before we really start seeing the fallout, because we've got people that have been unemployed for great periods of time. More importantly, we have businesses, the travel sector, the airlines, that have just been damaged terribly. A lot of them are going to go under. There is going to be carnage, and the government is going to try to do what they can to save those that they believe can be saved and need saving. And that will require an enormous amount of capital. In other words, we felt the first part. We haven't felt the fallout yet. The economic fallout will come after we've solved the pandemic and created a vaccine. Now people are going back to work, and the businesses that didn't make it are trying to restart up. And that's why I believe next year's deficit could totally be a lot larger than this year's.
Excellent, Gary. So I'd like to talk a little bit about the election again. We know that markets don't typically like uncertainty. So why are we seeing everything go up since Tuesday evening? Is this simply due to, as you were saying, buy the rumor, sell the fact?
Part of it's that. The other part is that with a Democratic administration, typically Democrats spend more than Republicans, although if you look at how much was spent in the last 4 years, I don't know that that's absolutely a given fact. But the key is that the uncertainty right now is that Trump is going to, by tooth and nail, call for recounts for votes. He's not going to go out easily. And so that creates uncertainty. And what we need in America more than anything else, and I've said this, whoever wins, let it be a peaceful transition of power. Because the earmark of the United States is for 200 plus years, every 4 years, or before there were term limits, but there was always a peaceful transition of power from one to the next. If that does not happen, it could create a lot of uncertainty. So I think there's the reflection on that. And then there's also the fact that a lot of money that individuals got from the stimulus packages run dry. And they are not happy campers. And so you're going to see, you could see, I should say, some civil unrest in terms of peaceful protests. And that's uncertainty also. So we're facing things we've never faced before. We're dealing with them in the best way we can. And I believe it's going to be science that will solve the issue that we're having. And there are those out there that believe there is not a pandemic, that it's all fake news. I happen to be in the other camp, but that's the kind of thing that will create uncertainty.
Perfect, Gary. So I'd like to get your thoughts on what you think the risk of having another liquidity crunch like we saw in March are right now.
I think that it could be dire, but I don't believe that that's going to happen. I really think the Fed has done everything that they could possibly do. They've added tons of liquidity into the market. They continue to buy, I believe, $120 billion worth of assets each month, which are mortgage-backed securities, or even buying corporate bonds now. And with interest rates as low as they are, there's money available and it's inexpensive. So I don't see us having a crunch in terms of the overall economy.
So as we're seeing again, on November 5th here, we're seeing equities and gold rise together. So what are the reasons for this correlation right now?
I think the main reason we're seeing this tandem run is the fact that the Federal Reserve is so active with their monetary policy. And the monetary policy is quantitative easing, and it's increasingly purchasing more assets. Those two scenarios, meaning an active Fed with quantitative easing and buying assets, is bullish for both gold and silver. It should affect the dollar, though. The dollar should have an inverse reaction to that, but the dollar's been very strong. And what I think we saw there was as stocks got liquidated, they went into cash. It's not that people are buying dollars as much as they're liquidating their stocks, and then that goes to cash.
Excellent. That was actually leading into my next question here. We're seeing the dollar lose some ground versus gold today. Is this business as usual, or is it warning us about something else coming?
I don't think that anything we've seen over the last, say, 3 to 6 months is business as usual. It's the new normal or the new business. The fact that many meetings are going virtual, that you're developing different types of technologies that keep people communicating together without physically being in the same room. I think we're seeing innovation. We're a resilient race in the human beings as a whole, in that we're able to solve problems and do so at a pace and a vigor that is just exponentially growing. If you consider where computers were, for example, 20 years ago and where they are now, where science was, where it is now. I'm past 65, so I remember the old days and the first computers and black and white TVs. I would have never dreamed that there'd be a person that had such vision that he would develop a rocket ship that could land back on a pad that's 50 meters by 50 meters. Elon Musk is a visionary, and those are the types of people that move the world to a better place. And so I'm positive and optimistic about the future because we have people like that.
Excellent. So, Gary, as you were talking about earlier, the world is being affected by this pandemic. All the economies around the world are being affected by it. So we're seeing a race to debase all the currencies around the world. Is there any point in holding cash on the sidelines in any currency right now?
Well, I think the answer to that question was in the question. Obviously, there has been a race to zero to devalue currencies across the board. That being said, and the fact that these currencies are all fiat, meaning they're backed by the faith in that government, it's possibly not the best place to park a percentage of your portfolio. I like gold. I like physical gold. I feel that that will always have intrinsic value. There's companies that I'm comfortable with that I feel will always have growth and potential. And then there's the cryptocurrencies. And the cryptocurrencies will find a place within the fabric of the financial markets, in that there will be a day when there will not be paper money. I'm already at that day. I don't carry money with me anymore. I haven't for years, but we're going digital. And the idea behind blockchain is powerful. The question is, will there emerge a major player like Bitcoin, or will it be a government cryptocurrency? Because the pushback that the governments give to these cryptocurrencies is that there's no way to see where the money's moving, to who and what. And the beauty of it is it's all transparent. Nobody can fudge the records because it's being done in a blockchain, meaning multiple people are working on that same particular transaction. The last thing that is really important to me about crypto is it allows third world countries and developing economies where small business people might only need to transfer a couple of dollars, and that means everything to them. They can do that with a cryptocurrency. And so there'll be value.
Gary, when you're talking about the intrinsic value of, let's say, gold and silver and some of these cryptos going forward, can you tell us a little bit, like maybe contrast gold and silver for us? Because we know that silver is considered more of an industrial metal right now. Do you think that'll give silver more room to accelerate towards the upside in this next bull market?
When I think about silver in relation to gold, I think of a candle burning at both ends. It burns twice as bright for half the time. When gold is moving up, you typically get silver moving up in tandem, but it will outperform gold in terms of percentage gain. The reciprocal is true. When you have markets in a deep corrective period, silver will tend to really have the deepest decline in terms of percentages as you look at gold. Gold is the standard, but when you consider the history of gold and silver, they were really the first currencies. They were the first currencies for a reason. There's only so much of those metals on the earth. There will never be more of them. Whatever came, and it's a matter of mining it and reusing it. But there is a finite amount of gold and a finite amount of silver. And there will always be intrinsic value in that.
That's a great analogy. I like that, Gary. When we were speaking before the call here, you were saying that you call yourself a hybrid technical trader. So tell us a little bit about some of the way that you think about being a hybrid technical trader and the things that you take into consideration there.
Well, the reason I label myself that is I believe that it is fundamental events that move markets. It's not whether it's above or below a 50-day moving average. However, when I was young, I was very, very fortunate. And I was mentored by Larry Williams and John Bollinger. And I was on tour with Larry Williams. I was very fortunate in that I was mentored by two great technical traders, John Bollinger, of course, of Bollinger Bands, and Larry Williams. I was on a lecture tour with Larry Williams, and we were having coffee. And he was telling me all kinds of beautiful stories. He says, first of all, do you remember I wrote a book of how I turned 10,000 into $1 million? I said, well, who hasn't read that? He says, what I didn't write about was that I gave it back 6 months later. And what I learned from that is it's not that hard to make money, but it's very difficult to hold on to it. But then he gave me the most important story that stuck in my head to this day. He said, Gary, as a technician, we're kind of like two sailors sitting at the end of a boat. We're watching the wake created by the propellers, and we're trying to judge where the boat's going by where the wake has been. He says, but you got to realize one thing. Only the captain knows when he's going to turn the wheel. And that always stuck with me in that it's those pivot points that are the most difficult to predict, unless you're the captain. And so what I realize is that if you combine Western technicals, and I also use Eastern technical indicators, and put them together and base them on a fundamental event, a scenario I see building, it gives me a very, very complex toolbox, which will give me price points to get in. Where do I move my stop? What is my upside target? The technicals that I use are a little different. I was classically trained as a Western technician. I use stochastics, moving averages, MACD. I still use the MACD to some degree, and I always use the 50 and 100, 200-day moving average. But I realized they were all lagging indicators. Anything based on a moving average is telling you what happened. You're looking at the wake behind the boat. And I had a trader who was uncanny in his results. I saw him hit 20 trades in a row. But more importantly, for example, when I remember oil was going up, it was breaking 100. And he called me up and he said, sell. And he gave me the number of contracts at the market. I said, you realize everybody's buying. He said, I know, just take my order. And I took his order and he hit the direct pivot point. And I asked him, how are you able to call these tops? Because if only the captain knows and he's not the captain, what information is he privy to that's giving him that kind of advance notice? And he said, I can't explain it to you, but I'm going to send you a book. And this is a book I would recommend to all of your subscribers and your followers. And it's the Bible to me. It's by a gentleman named Seiko Shimizu. It's called The Japanese Chart of Charts. It was released in 1989. And that's why in 1990 and 91, candlesticks became popular. Steve Nissan, of course, that was his Bible, and he made it easier to understand. The one thing about Shimizu's book is it is kind of cryptic. It took me 3 to 4 reads before it kind of hit me. But once I understood what he was saying, it was kind of like the Matrix opened up. I saw things I never saw before. I was able to predict things before they happened because I saw certain patterns occur in candlesticks themselves. For those of you that follow bar charts, candlestick charts use the exact same information: open, low, high, and close. In a bar chart, what you're getting is a vertical line representing the low and the high. You get a slash representing the open, and then a slash on the other side representing the close. To do a candlestick, you simply draw a rectangle around the open and close. But here's the important thing. The reason they do that is the Japanese view the markets differently than their counterpart Western trader. If I was to say to you, gold is up $50 today, intrinsically, you would understand that what I was saying was it was $2 yesterday and it's $52 today. In other words, I'm comparing the closing price to the closing price. The Japanese believe that it's during the market activity, during the trading session, that gives you the most information. And so what's important to a Japanese technician is not a close-to-close relationship, but rather where it opens and where it closes. Because that, to them, the expression they use, it tells them who won the battle that day. So if you get this long red candle where it opens near the high and closes near the low, it tells you that the entire day was dominated by the bearish faction. And that's not something you'll pick up just looking at a bar chart. And so I think candlestick charts are an incredible tool that everyone should consider adding to their toolbox. As I got more advanced, because I've been doing this for years, I started looking at Fibonacci and Fibonacci retracement. And I was astounded at how markets would rise. And when they fell and I put the different levels, it would tell me precisely that it could go here or here or here. It would give me 3 sets. And invariably, it would come close to one of those. And then when I added Elliott wave theory, which is art and science, some people think it's incredible and believe in it like myself. Some people think it's a little bit of voodoo. They don't put the same kind of credentials that I do, but I've used it for years and I've used it accurately. And by combining Elliott wave, because that's going to tell me a cycle, I'll know that if it's in a rally, it will do that with a series of peaks and valleys. And then there's rules at how long each rally should be compared to the other one, how deep the retracement should go. It gives me a roadmap. Now, the most difficult thing is to say, well, where is it going to end up if it is at a new price high? If a market is traded, for example, before gold broke above 1900, we knew that was the top and we could compare everything else to the top. But once it breaks it, how do you project where it's going to go? And what I have found to be very useful is a thing called Fibonacci extensions. And in essence, I'm looking at an Elliott wave count. Wave 3 is never to be the shortest of the wave. When you get the correction, all I do is I measure the length of that rally. And then from the starting point of the end of the decline, I do a 0.618% extension. And if you do that, it will be uncanny at how close it will come to those numbers. And so those are the techniques I use.
Very interesting, Gary. As you're talking about, the Elliott wave theory and the Fibonacci extensions, do you have any other books or resources that you like to kind of shed some more light on those?
For Elliott wave, there's a book called Masterworks. It is a great compilation of all of his short articles, everything that he's published. That's a must read. That's a standard for me. I like Steve Nissan's Japanese candlestick books, his first one especially, because he explains it in such a unique way. I wrote a book in 93, so I don't really want to do a shameless plug, but if I have to, it's a trading applications of Japanese candlestick charts. What I did was a little bit different. I looked at, are there specific patterns in oil or in gold or in cattle or in stocks? Are there timelines to use? And so we developed a software application. This is back in 1991 called the Candlestick Forecaster. We developed the first software application that used AI to identify patterns. And then when we started running models and testing them out, we saw some very interesting correlations of certain patterns that appear in certain markets with regularity that have a greater probability of being correct. But what I realized is that if I use that just alone, it's not enough. So you have to filter them through other things. And that's why I look at a candlestick pattern like a pivot or a bullish reversal if the market's coming down and it hits a fib level. And then I see the candlestick pattern. That's my entry point. Where's my stop? Well, it's just below that particular price point or a low before that. So I think that for candlesticks, it would be that, Masterworks, and Seiko Shimizu. Those are the books I'd recommend. I also do have a couple of articles on our site, thegoldforecast.com. You go under trading system at the bottom, you can download the PDF, and it will tell you precisely, it's where I disclose the entire method that I developed. No charge.
Excellent, Gary. That's very interesting. So again, going back to some of the research that I've done for today's call, you were saying that a normal rally could be anywhere between 100 to 150 points to go up and then a correction versus a strong rally of 250 to 300. And then what we saw earlier this year is 300 plus. So can you tell us a little bit about those different types of moves and what kind of different price actions we could expect from a market where we really have, unlimited physical stimulus, low interest rates, and possible flights to safety?
Yeah, that is an interesting set of numbers that I picked up. I just did it through a modeling and observation. And I noticed that when gold rallied, it typically rallied $100 to $150. Sometimes it broke above that and it might hit even 250 or 300. We've exceeded that on this last one, which means we had a basic parabolic rise. Parabolic rises scare me because parabolic up typically means parabolic down. But in terms of where it could go, I can give you a price number that I'm projecting, but the reason that those numbers are the amount that it will typically move, I do not have an answer for it. I have an observation that that's what I've seen. I don't have an explanation as to why that is.
Excellent, Gary. As we wrap up here, is there anything else you'd like to add?
No, I just want to thank you for taking the time. I want all of your subscribers to realize we're dealing with some tough times. And it is companies such as what you're listening to now that will give you the information you need to get through these tough times and maybe even prosper a little bit. And if you prosper, just give back. Just pay it forward. Because what we're teaching people to do is to make money. And money is just a vehicle. Pay it forward. And the last thing I'd say is just perform one act of random kindness a day. It'll pay you back in spades.
That's some sound advice there, Gary. I appreciate that. We can find more about you at thegoldforecast.com, also at The Gold Forecast on Twitter and at Gary S. Wagner. Gary, thanks very much for your time today.
Thanks for having me. It was a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?